Well, welcome everyone. I'm so glad that you're here today. I'm Mila Tappan. I am the Education and Affordability Content and Training Manager at the Finance Authority of Maine, or otherwise known as FAME. I'm thrilled that you are here today to talk about student loans, learn more about student loans. There's a lot of information out there, and we're so glad that you're here with us today to get the real straight information and know what options exist. Today's session is being recorded, and the link to the recording will be sent to all registrants automatically. Please ask your questions in the Q&A. We do want to know what your questions are. We have a very large group today, so we will answer as many of those questions as we can. The chat is open to the hosts, but please don't ask your questions in the chat. They're harder to track that way, and we do want to capture all of the questions that you have. So now I'd like to introduce our presenter of the day, who is Betsy Mayotte. So Betsy is the president and founder of the Institute of Student Loan Advisors, otherwise known as TISLA, which is a nonprofit organization that provides free, unbiased student loan advice to borrowers. Betsy has over 20 years of experience in the student loan industry, focusing on compliance, borrower advocacy, and federal student aid policy. Betsy is one of our favorite and most important partners here at FAME, and we're thrilled to have her with us today. So without further ado, I'm going to turn it over to you, Betsy.
Thank you very much. And I feel the same way about you guys. I love working with Fame and the Mainers. Um, okay, so couple housekeeping bits. As Mila mentioned, this is being recorded. And we ask that if you have questions, we love questions, that you put them in the Q&A. I will ask that you hold off on your questions until I cover the topic that your question pertains to. Because if I am doing my job right, I am going to answer that question as part of my narrative to you. With me today, I have superhero Q&A guy Addison. He can answer questions accurately and in plain English at the speed of light. So if you do have questions after I've gone through a topic that pertains to you, do not hesitate to just bombard him. Let's make him, he always earns his keep, but let's make him really earn his keep today. Sorry, Addison, not sorry. Um, so listen, I am going to be throwing a lot at you over the next hour. So don't freak out. This information is also on our website, which is freestudentloanadvice.org. And as part of our partnership with Fame, you all, as Maine residents, have a dedicated email address just for you, where you can ask your questions to us. And I'll throw that up at the end of the presentation, but it's fame at freestudentloanadvice.org. We answer 95% of our questions within a business day. So, again, if you do have questions after it's all over, you're just feeling overwhelmed, absolutely utilize that resource. So, most of what I'm talking about today, the genesis of it tracks back to H.R. 1, which was the big budget bill that was passed by Congress last summer, specifically in July. Now, that bill made significant changes to both that will affect both existing student loan borrowers as well as future student loan borrowers and those people that are in school right now. Now, the regulations that implement these changes to the law are still in draft form. With that said, and my presentation today is based on those draft regulations. With that said, I don't expect very much of that to change, if anything, because most of the regulation changes are based in law, and regulations can't deviate from the law. If there is something that might be a little bit of a gray area and could change before we get those final regulations, I will be sure to tell you. We should get those final regulations within the next, well, by June. Places that you can keep up with these changes is the Department of Ed's website, which is studentaid.gov, our website, which is freestudentloanadvice.org. And if you really want to nerd out on all of this, this last link on this page is the link to the Department of Education's negotiated rulemaking page, which is the process that they use to change regulations. And you can read the federal registers and all the other materials associated with these regulatory changes. If that link is sort of too long for you to take down, if you just Google Department of Education negotiated rulemaking, it'll come right up for you. All right, so here's how we're going to roll today. I'm going to start off talking about the repayment plans that are available for existing borrowers and what's going to change there. Then I'm going to talk about the repayment plans that are going to be available for new borrowers. I'm going to spend some time talking specifically about Parent Plus loans because there's some really important deadlines and kind of convoluted processes that Parent Plus borrowers need to know about. And then we're going to hit the changes to loan limits. All right. First, I want to make sure that we're all talking the same language. There are kind of three buckets of student loans that people can have under their belts. The first type and the most popular type are loans that fall under the federal direct student loan program. If you took your loans out on or after July of 2010, chances are they're a federal direct loan. So a federal direct loan can be a Stafford loan, whether it be subsidized or unsubsidized. It can be a Graduate Plus loan. It can be a Parent Plus loan. Where it can get a little more confusing is if you took federal loans out prior to 2010. In that case, you could have what's called a Federal Family Education Loan Program loan, or FEL. You could have a Perkins loan. Perkins loans, they stopped making those around 2017, I believe. If you went to medical school years ago, you could have what's called a HEAL loan. There's also a federal loan program called Loan for Disadvantaged Students. All of those in this yellow box are federal loans, but for the most part, they aren't eligible for a lot of what we're talking about today, but can be made eligible if you consolidate them into the direct loan program, which you can do at studentaid.gov. There's pros and cons to that, and I'll talk about those in a few minutes. You could also have a private loan, which is a loan borrowed directly from a bank where the federal government's not involved at all. You could have what we call an institutional loan, where the school is actually the lender and you owe the school directly. And many states have state loans. So, for example, here in Massachusetts, we have the Mass No Interest Loan. In New Jersey, they have, I don't think it's called this anymore, but it used to be called the NJ Class Loan. Rhode Island Student Loan Authority has state loans as well. Private loans, institutional loans, state loans are never eligible for any of the things that I'm going to be talking about today. Even if it used to be a federal loan, some people make the choice, which the vast majority of the time is not a good choice, to refinance their federal loans into a private loan. There's no take backsies there. And once you do that, you lose access to all the benefits and safety nets that are unique to federal student loans. I'm getting a little froggy, so I'm going to pop a cough drop to try to ameliorate that. Okay, so again, vast majority of you have direct loans. It's possible you have federal loans that aren't direct loans, but you can make them direct loans by consolidating them. Any other loan type is not eligible for any of these things. If you're not sure what kind of loan you have, the best thing to do is to log into studentaid.gov and it will say direct Stafford loan or FEL Stafford loan. Your servicer most of the time will also have that information on their website. Worst case scenario, call your servicer and ask them, and they will let you know whether you have a direct loan or a FEL loan or a Perkins or something else. Um, if it doesn't appear on studentaid.gov, it's not a federal student loan, and you'll want to look at your credit report to see who the holder is. Okay, let's talk about what a consolidation is. Consolidation in the federal student loan world is different from refinancing in any other type of consumer loan, including private student loans. Consolidation is when you take your individual student loans and apply for a loan to pay all those off and create one great big fat new loan. Now, I say it creates one great big fat new loan, and it does from a legal perspective, but the way they book it can be a little bit confusing because they usually book it on the Department of Ed stuff in two parts, a subsidized portion of your consolidation and an unsubsidized portion of your consolidation. That's just really for record keeping purposes, if you're eligible for any type of interest subsidies, but legally it's a single loan. Um, when you consolidate a federal student loan, you're not out there looking for or negotiating a lower interest rate like you would when you refinance another type of consumer debt. There's no negotiating interest rates on federal student loans, unfortunately. The interest rate on a consolidation is a weighted average of the interest rates on the loans you're consolidating, and then they round up to the nearest eighth of a point. So it's pretty much a wash. Nobody ever consolidates for interest rate reasons these days. One benefit of consolidation is if you do have FFEL loans or Perkins loans and you're trying to get access to certain payment plans that are only available to direct loans, or perhaps you're pursuing public service loan forgiveness, Parent Plus borrowers in particular, as you'll see later in the presentation, definitely want to consider consolidation. Those are good reasons to consolidate. But the fact of the matter is if you don't have FFEL, you don't have Perkins, you don't have Parent Plus, the vast majority of direct loan borrowers, there's really no need or benefit to consolidating your loans. It used to be that we told everybody to consolidate. This was back in the early 2000s. And during the Biden administration, we advised a lot of people to consolidate. And there were good reasons for that, but those reasons are don't exist anymore. Um, so again, if you have all direct loans, um, and no Parent Plus, chances are consolidation is not really going to benefit you. Now, can be drawbacks to consolidation. For example, if you're pursuing forgiveness under the income-driven plans and you already have a lot of payments under your belt, consolidation will reset that count to zero. Now, it doesn't do that for PSLF. It used to, but it doesn't reset the count for PSLF. If you consolidate loans that already have PSLF counts under their belt, they give you a weighted average of those PSLF counts when you consolidate. The other drawback to consolidation is if aggressive repayment is your best student loan strategy, which for most people it is. Most people are not going to end up getting loan forgiveness just because they don't owe enough to benefit from loan forgiveness. If you're pursuing aggressive repayment, if you consolidate, you lose the ability to, if you're going to throw extra money at the loans, to target specific loans. So if you're doing aggressive repayment, we usually tell people if they're going to throw extra money at it beyond what they're being billed, to throw that extra money at the loans with the highest interest rate. And if you consolidate, there is no loan with the highest interest rate anymore because you only have the one loan. So think carefully about consolidation. We spell all of this out on the consolidation page of our website if you want to dig a little bit deeper about the pros and cons of loan consolidation. All right. I want to give a broad overview of some of the changes affected that were caused by HR 1. I'm going to warn you ahead of time. I'm going to be very repetitive about some of this. And that's not because I'm slowly losing my mind, although that might also be true. It's because it's so important I want it to stick. So it's a little early to be playing a drinking game at home. But if you are playing a drinking game at home, please do not use July 1st as your moment to drink because you're not going to make it through this presentation. Um, so again, it's not me being fruity. It's me trying to make sure that these really, really important things stick. All right, so anyone who borrows or consolidates a loan on or after July 1st of 2026 will only have access to the new RAP repayment plan that I'm going to talk about in a little while, or the new tiered standard plan. That includes people that already have loans. So the next slide, I'm going to start going into the payment plans that are available to people that have existing loans. If you borrow again or consolidate on or after July 1st, 2026, you're going to lose access to all the plans I'm about to talk about. The payment plans I'm about to talk about, a lot of them, your eligibility is based on when you took out your very, very first student loan. Now, let's say you took out your very first student loan in 2002, but then in 2015 you consolidated. That doesn't change the fact that you took out your first loan in 2002. Consolidation never changes your loan history, so to speak. So that's really important to remember. Um, you essentially can't change your loan history. So let's say you have loans from 2002 and you also have loans from 2015, and you want to be eligible for the plans that are only available to people who never borrowed prior to 2014. Paying off that loan from 2002 is still not going to get you access to those plans because that loan is, for want of a better expression, has contaminated the newer loans. Now, with that said, the Department of Education has a bunch of glitches right now. And one of those glitches is for people who did have loans prior to 2014 and they've since consolidated, it's telling you you are eligible for those payment plans that are only available to people who never borrowed prior to 2014. In fact, they're even giving people some of those plans right now. Um, it's a lie. It's a lie, I tell you. They are going to fix it. I don't know when they're going to fix it, but you need to be aware that it is giving people incorrect information. The other thing it's doing that's incorrect, and this one is really burning my buttons, is it's giving people a message saying, hey, if you consolidate, you might be eligible for other plans. That is the only time that's true is if you have FFEL loans or if you have Parent Plus loans. The rest of the time, it's absolutely not true. And as I mentioned, if you're pursuing forgiveness under the income driven plans and already have a bunch of payments under your belt, it will harm you if you consolidate. So hopefully they fix that soon. As I mentioned, that one in particular is really giving me a lot of anxiety because it can cause people to take action that will harm them. So just be really wary about that type of messaging that you're getting on the Department of Ed website right now. Now, the triggering event for payment plan eligibility and other eligibility for certain types of deferments and that kind of thing too is always the first disbursement date of that oldest loan. And you can find out what that is at studentaid.gov. If you go into your loan details and your loan history, you'll be able to see the date each loan was first dispersed. So most people, I think, on this call probably haven't borrowed prior to July 1st, 2014. So this won't really matter to you, but there are still a lot of people that have loans older than that. So it's really important to say that. And then again, regardless of that, if you borrow or consolidate on or after July 1st, 2026, you're going to lose access to all the plans I'm about to talk about. And you'll only be able to get the RAP or the new tiered standard plan. All right, so let's talk about these plans. So, federal student loan repayment plans fall under two buckets. There's a bucket of plans where your payment is not based on your income at all. It's based, the amount that you're going to have to pay every month is going to be based on your balance, your interest rate, and the term of the loan. And everybody who doesn't borrow or consolidate on or after July 1st, 2026, whether you have FFEL loans, whether you have direct loans, whether you have Parent Plus loans, you're all eligible for the payment plans you see in front of you. Again, it doesn't matter. You could have a vintage loan that was taken out in the 1970s, and you would be eligible for these plans you see in front of you, as long as you don't borrow or consolidate on or after July 1st. So these plans are as follows. The first is what we call the 10-year standard plan. That's the plan you're going to get put into when you first go into repayment if you don't consolidate and you don't actively pick another plan. For people that are going to end up paying their loans off themselves, this tends to be the cheapest plan for you, meaning you're going to pay the least amount of interest over time. They're going to figure out how much you have to pay every month for where the loan is paid off within 120 months, and 120 months is 10 years. Now, listen, if you don't owe that much, they're not going to drag it out for 10 years. The minimum payment allowed under the standard repayment plan is $50 a month. So if you only owe, say, 3 grand, your payment's going to be $50 a month, and you'll pay it off, well before the 10 years is over. And when I say $50 a month, I mean, so let's say you had 5 loans at $3,000 each. So you owed a total of $15,000. your total payment under the standard repayment plan would be based on the 15 grand. They wouldn't assign you $50 per all five $3,000 loans. So they do a collective calculation. Graduated repayment. Graduated repayment is one of the few plans that's sort of self explanatory by the title. You're going to start off as interest only payments for the first 2 to 4 years, and then your payment is gradually going to go up every year. Assuming you haven't consolidated, you're still going to pay it off within the 10-year period of time. Extended repayment. That's for people who collectively owe at least 30 grand. They extend the term to 25 years instead of 10 years. And they do that without having to consolidate. So you could still target individual loans if you want to for extra payments. But other than that, it works the same way as the 10-year standard. They figure out how much you have to pay every month to pay it off within the 25 years. And then if you mush together graduated and extended repayment, um, you're going to pay interest only for the first 4 years, and then they're gradually going to increase the payment every year and ensure you pay it off within the 25 years. And again, you have to owe at least 30 grand. Um, Defaulted loans are not eligible for any of these plans ever. Any of the plans I'm going to talk about, with the exception of IBR, once you default, you lose access to all the benefits available to you until you rehabilitate or consolidate the loan out of default. We don't have time to talk about default today and how to resolve that. But if your loans are in default, if you go to our website, there's a delinquency and default page that explains how to get out of default. You can also find that information on studentaid.gov. All right. Before I get into the income driven plans, I'm going to take a breath and a sip of water, and I'm going to check in with Addison and see if there's any questions about what I've covered so far.
Thanks, Betsy. There seems to be some confusion about whether old loans still influence eligibility for newer programs.
Um, I'll try to explain, but I'm not sure I understand where the clarity needs. So you may need to clarify the need for clarity for me. Um, so are they asking more about the July 1st stuff, or are they asking more about, the whole grape juice in a glass thing?
Grape juice in a glass.
Sorry, what?
I think he said grape juice in a glass.
Okay. All right. So let's say you took out loans in the year 2000. And before paying those loans off, you go back to school, or you have children that go to school, and you take out new loans in 2015. The fact that those loans that you took out in the year 2000 are going to forever contaminate the newer loans you took out as far as your payment plan eligibility goes. Consolidation doesn't change that. Um, Paying off the older loans also doesn't change that unless you completely pay them off before taking the new loans out. The analogy I like to use, and this is why I asked, does he mean grape juice in a glass? Here's the silly analogy I like to use that sometimes helps. So let's say you have a glass of grape juice in front of you. You empty half the grape juice out and you fill the rest of the glass with water. I think we can all agree there's still grape juice in the glass. Then from there, you empty out 90% of what's in the glass and you fill the rest of the glass with water. Even though the color of what's in the glass might be mostly clear, I think we can all still agree there's still grape juice in the glass. If you would have to completely empty that glass, rinse it out, so there's no more molecules of grape juice in it, before you filled it with water, before you could say there was no grape juice in the glass at all. And that's what I mean about old loans contaminating new loans. If you did take out older loans and then took out newer loans, even if you later paid off the older loans or consolidated, those older loans would forever contaminate the newer loans. The only way around that is if you completely paid off your federal student loan balance to zero, where you didn't know anything anywhere before taking out the newer loans.
So Betsy, can I just jump in and clarify? So someone has asked the question about, is the triggering event still the first disbursement of the first loan ever, even if that loan has long since been paid in full? And I think you just answered that. There's a distinction between old loans that have been repaid in full versus ones that still have an outstanding balance, correct?
That's correct. And I love that question for adding clarity to me attempting to add clarity. So in the scenario you posed where the question being is the first disbursement date of the oldest loan still the triggering event even if I have long ago paid off that oldest loan? The answer is yes, assuming you took out your newer loans before you paid off that older loan. Now, if you paid off that older loan and all other loans where you owed nothing before taking out the newer loans, then that wouldn't be your triggering event. So the glass has to be clean before you fill it again. How's that? Clear as mud? Anything else, Addison?
No, that's it for now.
He might be having trouble with his headset today.
Yeah, sounds like it. I thought I heard him say no. I think we're all set.
Okay. All right, so let's talk about the income-driven plans. So these are the plans that are currently available to existing borrowers. But again, your eligible this is where your eligibility is really gonna um, matter on what the first disbursement date of your oldest loan is. Um, so the first one I want to talk about is old IBR. Now, old IBR, every direct loan, every FFEL loan is eligible for it unless you have a Parent Plus loan that hasn't been consolidated. And again, I'm going to talk exclusively about Parent Plus loans in a little while. So old IBR doesn't matter when you took your first loan out. Again, if you have a vintage FFEL loan from the 70s, you are eligible for old IBR. Parent Plus loans, it says you have to be double consolidated. If you have double consolidated your Parent Plus loans in the past, when that was a thing, you are still eligible for old IBR. Those of you who are going, what's double consolidation? Don't worry about it. It's not a thing anymore. But you will also be able to have access to old IBR, even if you never never double consolidated, as long as you consolidate in the next month or so. And again, I'm going to talk about that in a little bit. New IBR is only for borrowers where their very first student loan was taken out on or after July 1st, 2014. And that's when this grape juice thing comes into play. If you have some loans prior to 2014 and some loans post 2014, you are not eligible for new IBR. The other thing is, new IBR is only for direct loans. So FFEL loans aren't eligible for it. And Parent Plus loans, same thing applies. You're not eligible unless you consolidate in some way, shape, or form. The pay-as-you-earn plan. Pay-as-you-earn, as you'll see, is like the fraternal twin of new IBR. The calculation of the payment's the same. The forgiveness timeline is the same. The only difference really is the eligibility. So again, only direct loans. Same rule applies for Parent Plus. You can't have any loans taken out prior to October 1st of 07. And you also had to have at least one disbursement on a loan, which could be a consolidation, after 2011. Now, the pay-as-you-earn plan, you could still get on it now, but they're phasing it out by July of 2028. So there's no harm if it's the best plan for you to get on pay-as-you-earn now, but you're going to have to probably switch plans come the spring or summer of 2028. And there won't be any negative consequences just by switching plans. You won't lose any counts anywhere and all that. But just be aware you are going to have to switch if you get on the pay plan or if you're on the pay plan now. Income contingent repayment. Um, this is for all direct loan borrowers. Doesn't matter when you took out your first one. The oldest direct loan is from 1994. If you have a direct loan from 1994, you are eligible for ICR. If you have loans older than that were fell and you consolidated them into the direct loan program, you can get ICR. Parent Plus loans can access ICR if they consolidate. Um, this is also being phased out by July of 2028. But again, same with pay. You can get on it now, and there won't be any negative consequences to you when you're forced off it come 2028. Now, there is a new plan coming July 1st that I've already mentioned in passing, which is called the RAP plan. All existing direct loan borrowers are going to be eligible for the RAP plan, regardless of when you took out your first loan, with the exception of Parent Plus borrowers. Parent Plus borrowers, consolidated or not, will never have access to the RAP unless Congress changes their mind in the future and changes the law. Not impossible, but you should not be strategizing around that by any means. If they do change their mind, I don't think it'll be anytime soon. And again, they might not ever change their mind on that. So again, Parent Plus loans, consolidated or not, are not eligible for the RAP. Even if those Parent Plus loans are consolidated with non-Parent Plus loans, you're not going to be able to use the RAP on that consolidated loan because it's contaminated by those Parent Plus loans. All right, so there's a couple things that are common amongst all the income-driven plans. They all base your payment on your income. So you could have two borrowers, one owes 50,000, one owes 500,000. If they both have the same income and family size, and they both have the same loan history, they're going to have the exact same payment amount under these income-driven plans. Whereas under the non-income-driven plans, someone who owes 50,000 versus someone that owes 500,000, they're going to have very, very different monthly payment amounts. All the income-driven plans require that you recertify your income on an annual basis, and therefore you should expect your payment to change every year unless your income hasn't changed. Now, I say that, and some of you are probably going, wait a minute, I haven't had to recertify my income in years. That's right, that's because of the COVID pause, and then also due to the litigation around the payment plan called the SAVE plan, which those of you who are stuck in SAVE limbo, yes, I am going to talk about SAVE in a minute. But going forward, you should fully expect to have to certify your income on an annual basis because that's what's supposed to happen. All the income-driven plans do forgive if you have a remaining balance after a certain amount of time. Some of them forgive after 20 years, some forgive after 25, and the new RAP plan forgives after 30. Now, we talk about it forgives after 20 years, it forgives after 25, it forgives after 30. It's not really number of years. It's not really a clock. It's more like a ladder. It's actually 240 qualifying payments that are required under new IBR and pay as you earn, 300 under old IBR and ICR, and 360 under the RAP. Now, all of these plans cross pollinate with each other, meaning any eligible payments you accrue under, say, new IBR will also count towards the RAP and vice versa. So, from a count perspective, there's no penalty with switching plans ever. The only thing that will hurt you in your counts is if you consolidate, because as I mentioned, consolidation resets your counts to zero. Now, due to some waivers that were done under the Biden administration, if you consolidated prior to June of 2024, your counts didn't reset. In fact, you may have gotten even extra counts due to that waiver. But that was like a one-time waiver, and I would not expect that again. I would expect, again, the rule is going forward, if you consolidate it, reset your count to zero under the income-driven plans, not public service loan forgiveness. Public service loan forgiveness, the counts never reset. Again, if you consolidate, they give you a weighted average of the PSLF counts you had on the loans you're consolidating. if you get forgiveness under the income driven plans, and the effective date of that forgiveness was after December 31st of 2025, you should expect that the amount forgiven to be taxed as income. Now, that doesn't mean if you get 50 grand forgiven, you're going to get a tax bill of 50 grand. It's taxed just like the rest of your income is. And you can set up payment plans with the IRS. They also have something called the indigency defense, where if your tax bill is higher than what you're worth, they'll compromise on that amount. I see a lot of people that shy away from this forgiveness or are afraid of it because of the tax bill. But in the end, even with the tax bill, it's still going to cost you less than it would if you paid the loans off in full yourself in that particular scenario. Other things that these plans have in common. If both you and your spouse, if you're married and you file your taxes jointly, they're going to utilize both of your incomes in the calculation of your payment plan. Now, if you're married and you file your taxes separately, they're only going to use your income. If you live in a community property state, your adjusted gross income is going to be, if you file your taxes separately, is going to be half of your combined joint income. If both you and your spouse have student loans and you both get on an income driven plan, they're going to look at your combined incomes, figure out what your payment would be collectively between the two of you, and then portion it out between the two of you. So let's say, based on your combined incomes, your payment would be $300 a month, and one of you owes twice as much as the other. The person that owes twice as much as the other, your payment's going to be $200 a month, and the person that only owes a third of the total balance will have a payment of $100 a month. I want to give sort of a pro tip. If that situation applies to you, where you're married and both of you have student loans and both of you are on income driven plans, do not apply for your income driven plan or recertify your income through studentaid.gov. You need to submit applications directly to the loan servicers. Otherwise, they're not prorating the payment amount. They're giving you both the total amount for your payment. So at least for now, until further notice, if that's your situation, be sure to apply for your income driven plan directly through the loan servicer. All of these income driven plans, with the exception of the RAP, if your income is low enough, you could have a payment of $0. Now, this is kind of a weird philosophical thing. Having a payment of $0 is different from not being due a payment. So, for example, if you're in deferment or forbearance, you're just not due a payment. But if you're actively on an income driven plan and not like on the save forbearance, and your income is low enough that your payment calculates at $0, that is considered a payment. So it's kind of like if a tree falls in the forest and no one's there to hear it, doesn't make a sound. A $0 payment counts towards the forgiveness baked into the income driven plans, and it also counts towards the forgiveness for public service loan forgiveness. But again, you have to be in active repayment and have a $0 payment, not in deferment or forbearance. All right, I want to show you a little math around how new IBR, old IBR, and pay as you earn act. They all start with your adjusted gross income. ICR also starts with adjusted gross income, by the way. And then they subtract 150% of whatever the poverty level is based on your family size and state. And then they multiply it by a certain percentage depending on which payment plan it is. So let's look at an example. So let's say you have a family of 4 in Maine, and the AGI of the borrower is $62,000. The adjusted gross income, which is what you get off your tax return, is $62,000. So the first thing we're going to do is look up what the poverty level is for a family of 4 in Maine. And the poverty level in 2025, it's gone up a little bit for 2026. The poverty level in 2025 for a family size of four, 150% of it. Um, sorry, the poverty level for a family size of four in Maine was $32,150. 150% of that works out to 48 grand and change. So you subtract the 48 grand and change from the AGI, and that gives us a remaining balance of $13,775. We divide that by 12, which is the number of months in the year, and we get 1148. Now, for new IBR and pay as you earn, which uses 10% of your discretionary income, we're going to multiply that by the 10%, and therefore your payment under those plans would be $114. Old IBR uses 15% of your discretionary income. So your payment under old IBR would be $172. Um, Income contingent repayment, as you'll see in a second, works a little different. They still work off of what we're calling discretionary income, but the discretionary income is your AGI minus only the actual poverty level based on your family size. It's not 150% of the poverty level. And for that reason alone, in addition to the percentage they use, ICR for most borrowers, but not all, tends to be the highest monthly payment amount of all the income driven repayment plans. So ICR, sort of the redheaded stepchild of the income driven plans. So ICR, they're using 20% of your discretionary income divided by 12. So AGI minus 100% of the poverty level multiplied by 20%. But there's also an alternative calculation. The alternative calculation is harder to math. What they do is they figure out what your payment would be if you were on a 12-year term. And then they multiply that payment by what we call an income percentage factor. Now, the IPF is something unique to this payment plan. It's published every year and changes every year, much like the poverty level does. And it's published via Federal Register. I apologize. I thought I had updated that Federal Register link to the one from 2025, but apparently I did not. I would not bother to math this one yourself. I would use the calculators that are out there for this anyway. But anyway, so that they figure out what your payment would be on a 12-year plan multiplied by this income percentage factor. And then whichever payment amount comes out the least, the 20% one or the IPF one, that's going to be your ICR payment. Now, for borrowers whose income is much higher than what they owe, in that scenario, ICR is probably going to be your lowest payment. And it's because of that 12-year calculation that it works out that way. Now, as I mentioned, pay as you earn and ICR are getting phased out in 2028. And for existing borrowers that don't borrow again or consolidate on or after July 1st, 2026, other than the payment plans not based on income. So you're still going to have graduated, extended graduated, 10-year standard, the standard plan that's available if you consolidate. But for income driven plans after 2028, here are you're only going to have new IBR if you don't have any loans prior to 2014, old IBR if you do, and in both case scenarios the RAP, unless you have Parent Plus loans. And again, if you borrow on or after July 1st, 2026, you're only going to have the RAP and the tiered standard plan. All right, before I start talking about the Parent Plus borrowers, I am going to once again check in with Addison.
And I'm going to hope that you hear me.
I can.
Fantastic. Um, Looks like you're about to get into it, but there have been a bunch of questions about Parent Plus loans.
Well, then that's a great transition.
Exactly.
Okay. Boy, they were not nice to Parent Plus borrowers in HR1. I'm just going to say it. So, Parent Plus loans were never eligible for any income driven plan. unless they consolidated. And if they consolidated once, they were eligible only for ICR. Now, they were always eligible for the non-income driven plans, and that includes if they consolidated, and that remains. As I mentioned, there used to be something we called the super secret double consolidation loophole, where if you consolidated a Parent Plus loan twice, you could then get access to pay as you earn, an IBR, as well as ICR. The time to do double consolidation is gone. You just don't have time to do it. Because remember, anybody who borrows or consolidates on or after July 1st, 2026 is going to lose access, if you have Parent Plus loan, to everything except for the tiered standard plan. So there's no time to do a double consolidation anymore. But if you already did one, you're still eligible for IBR, pay as you earn, in the non-income driven plans. What HR1 said is that a Parent Plus borrower who consolidates just the once, or again, if you double consolidated in the past, where the consolidation is complete, not applied for, completed, processed, made by June 30th, essentially June 30th of 2026, you will then be eligible for ICR, just like you were before. And then after that, as long as you just make one payment under ICR, you will then be grandfathered and can switch to income-based repayment, which, as I mentioned, for most borrowers is a lot lower payment amount than ICR is. I don't know why they made it so convoluted, but they did. Now, because you have no control over how long it takes a consolidation to get processed, and there's going to be zero ways to escalate that, we strongly advise that anybody with a Parent Plus loan, whether you think you're going to need access to IBR or not, that you consolidate and submit your application no later. And this will be a nail biter for me. I wanted people to do it by the end of February, but you could probably do it by the end of March and still get it processed by July 1st. Now, most of the time it takes around 60 days for a consolidation to happen. But because of this July 1st, 2026 nonsense, I predict there's going to be a huge volume in consolidation applications, and that could make them take longer. So just to preserve your eligibility for IBR in case you need it in the future, even though you may not need it now, I strongly recommend you apply for consolidation again by the end of March. Now, one caveat I want to make for that. For those of you that still have kids in school and you're deferring your Parent Plus loans and plan on not starting payments until after they're out of school, you lose the ability to defer based on your child's in-school enrollment once you consolidate. It's kind of an obscure rule, but it's there. I actually double-checked the regs on it last night, as a matter of fact. So again, if you have existing Parent Plus loans, we strongly recommend that you consolidate so you preserve your eligibility for IBR, whether you think you might need it or not. You'll still be eligible for the other non-income driven plans. And then you make one payment under ICR. That one payment under ICR, you don't have to get that done until 2028. But once you do make that single payment under ICR, you can move to IBR or graduate it or another plan if you want. Now, once you get that done, you can never borrow again under your name or consolidate on or after July 1st, 2026. So if you're a family that still has children in undergraduate school or have children coming up the pike that will be entering undergraduate school, but you are counting on the income-driven plans to afford your Parent Plus debt, and or maybe you yourself work for a government or eligible nonprofit employer and we're counting on using public service loan forgiveness to provide some relief on your Parent Plus debt, you're between a rock and a hard place. You absolutely need to follow this consolidation thing by July 1st. But again, you can't borrow again. or you're going to lose eligibility to everything on all your loans, new and old, except for the tiered standard plan. And I haven't gone over the tiered standard plan yet, but I can tell you it's not PSLF eligible. So you, and it's not forgiveness eligible. So you lose access to all lower payment options and all paths to forgiveness if you borrow or consolidate on or after July 1st, 2026. So if you do still have kids in school or have kids coming up the pike, there's only two things you can do. If possible, have the other parent borrow the remaining Parent Plus loans that are going to be needed in the future, and know that those loans are only going to be eligible for the tiered standard plan and won't be eligible for any of these forgiveness things or lower payment options. So you need to budget accordingly. Or go the private loan route. And the private loan route's no better. Private loans have even less safety nets than new Parent Plus loans are going to have. They almost never have lower payment options. They don't have deferments for the most part, and you have very limited forbearance, and the interest rates can be quite high. So it's even. I mean, I've always recommended that families budget not just for this year of school, but for the whole school period. But it's even more important that you do that now because of these changes to Parent Plus loans, and as you'll see in a little bit, also because of the changes coming to loan limits. Now, if you have Parent Plus loans, but you also have loans that you took out for your own schooling, um, I still recommend that you consolidate. But if you keep those loans um, separate from the loans you took out for your own schooling, you'll still be able to get access to IBR and so on the other plans on your other loans. But again, not if you consolidate or borrow again on or after July 1st, 2026. So just to clarify once again, the roadmap you need to follow if you have Parent Plus loans. You need to apply to consolidate by the end of March. You do that at studentaid.gov. You could apply for ICR as part of that consolidation application. Remember, your ICR payment is probably going to be pretty high, but you only have to make one of them. And then you could switch again. You make that one ICR payment before July of 2028. Then you could switch to IBR or graduated repayment or whatever other plan you want. Don't borrow or consolidate again on or after July 1st. Um, and if you do need future Parent Plus loans, or if you go back to school yourself, um, either go the private loan route or have the other parent do the borrowing. Anything I didn't cover that was being asked on the Parent Plus loans, Addison?
No, I think you covered it nicely, as always.
Thank you. All right, so listen, I've talked about forgiveness a lot, but I want to steer you away from a trap that we all get into. We all get caught up in the word forgiveness. I am a sucker for a buy one, get one free at the grocery store without doing the math myself. The name of the game isn't forgiveness. The name of the game is paying the least amount out of your own pocket over time. And for some people, that does mean pursuing loan forgiveness. But for other people, it might mean paying their loans off aggressively. So when you're analyzing your strategy, that's the big thing you want to look at. Now, for that reason, I wanted to do a side-by-side comparison of some of these payment plans. Now, in this example, we have someone with a $95,000 balance. They have an AGI of 30 grand, family size of 2 in Maine. We're assuming that their income is going to go up 2.5% a year. So, in that scenario, if the borrower consolidated, they'd have a 30-year term. They pay $570 a month, and they pay back a total of $205,000 over the 30 years. If they went on old IBR, so if they had loans prior to 2014, they'd be on old IBR. Their payment would initially be $52 a month, and then assuming that income growth, it would go up every year. Their final payment would be in the $112 range, And after 25 years, they pay back a total of around $23,000 and get the rest forgiven. New IBR, their payment would be lower at $35 a month. And after 20 years, they'd only pay back about 11,500 and they'd have the rest forgiven. Pay as you earn, again, it's the fraternal twin of new IBR, so the math is the same. Revised pay as you earn, which doesn't exist right now, but it could come back briefly before 2028. Um, the math is close to the same. And then for ICR, the payment would be $213 a month, going up to 401. And they pay back a total of about 90,000 and get the rest forgiven after 25 years. Now, all of those forgiveness timelines go down to 10 years if the borrower also works for an eligible nonprofit or government employer for PSLF. All right, let's talk about the SAVE litigation. So the Biden administration created another income-driven plan called SAVE, and it was by far the most generous, both from a monthly payment amount perspective and also from a forgiveness perspective. Unfortunately, 13 state attorney generals in Republican states thought it was too generous and thought that the Biden administration had gone beyond what authority they had under federal law and under congressional intent for how these income-driven plans work. And therefore, they challenged the SAVE plan in court. Listen, I've been working at student loans since the earth cooled. I have researched higher ed policy back to the 60s. No one's ever challenged a repayment plan in court before, ever. So this was unexpected for that reason. And even things that have been challenged in court, usually the changes made were prospective only. But that's not what happened here. Now, while that case is still technically pending, the judge in the case made it pretty clear right from the beginning that they agreed with the plaintiffs. And for that reason, they said you can't, while we're going through the paces on this case, you have to stop allowing people into SAVE, and everybody that's already in SAVE, you need to stop accepting payments from them and you need to put them in forbearance. So anybody that was in SAVE, whether they applied for it actively or whether they were automatically transitioned to it because they were on the repay plan before that, you've been in limbo for a while. And that SAVE forbearance doesn't count. You haven't been due for payments, and for a while you weren't accruing interest, but you started accruing interest again on August 1st. You're still not due for payment, but these months don't count towards income-driven plan forgiveness, and they don't count for public service loan forgiveness, although there's a way to make them count later, which we talk about on the PSLF page of our website. Unfortunately, we don't have time to go over that today. You have a choice. You can either stay on the SAVE forbearance and ride it out as long as it's available, which I will talk about that in a minute, or you could switch plans now and start accruing payments to, if you're pursuing forgiveness, I do recommend you switch plans now so you start accruing credits towards those forgiveness programs again. Now, you can pay while you're in forbearance. If you're someone's going to end up paying your loans off yourself and not getting forgiveness, this is kind of a gift in that you can make payments and target certain loans because you're not technically due for a payment. So you could target the highest interest loan for payments right now if you wanted to. Let's talk about how long SAVE limbo is going to be. A lot of you have a date on your account of 2028 or 2027. Those are placeholder dates only. There is a settlement in the works. We fully expect that people under the SAVE plan will be forced to switch to another plan sometime this year. We thought it was going to be by now, to be honest with you. We're just waiting for the judge to sign off on the settlement agreement. So you should start, whether you plan on riding out the SAVE forbearance as long as you can or switching plans, you should be spending the weekend doing your research to see what the best plan is for you, because you will have to switch this year. I can almost guarantee it. As I mentioned, you're generally required to recertify your income annually. You may not have been required to do so for a while, but you will be required to do so again. When you switch plans, you do have to submit proof of income when you switch plans. All right. I know we're running out of time. I'm sorry. But I want to get through the rest of this. Repayment assistance plan, repayment assistance program, or the RAP. The way that's calculated is they take your adjusted gross income, um, and they multiply it by a certain percentage, and then they divide that by 12, and that's going to be your monthly payment amount under the RAP plan. Now, if your AGI is 10 grand or less, your payment's going to be $10 a month. So $120 a year divided by 12 is $10 a month. There are no $0 payments under the RAP. If your AGI is between 10 and 20 grand, they're going to multiply that by 1% and then divide by 12, and that's your monthly payment amount. If your AGI is between 20 and 30 grand, they're going to multiply it by 2%, and so on and so forth, until you get to the point where your AGI is over $100,000. Anything over $100,000, even if it's $1,000,000, the maximum they're going to multiply it by is 10% and then divide by 12. Now, um, if you have dependent children, once they figure out your monthly payment for every dependent child where you provide at least half their support, they subtract $50 a month per dependent child. So let's say your calculated payment comes out to $300 a month. You have 2 dependent children. They're going to subtract $100 from that, so your payment will be $200 a month. There's a couple nice things about the RAP. First of all, if your monthly payment is less than the amount of interest you're accruing on your loans every month, the government's going to forgive the rest of that interest. So your balance is never going to grow. Now, that only applies if you make your payment on time. The RAP is unforgiving in that way. All the benefits I'm going to talk about the RAP plan, including its eligibility for public service loan forgiveness or the forgiveness program that's baked into it after 30 years or 360 payments on the plan, you don't get credit for any payment that's even 1 day late beyond your due date. And you don't get the interest subsidy, and you don't get the other benefit that I'm going to explain in a minute. So your payment has to be exactly on time or early. Um, so in addition to that generous interest subsidy, um, if your payment doesn't also take at least $50 off your principal balance, the government's going to throw in whatever needs to be thrown in to make sure you have $50 taken off your balance every month. So not only is your balance not going to grow while you're on the RAP, even if your payment is very, very low, let's say you have a $10 a month payment, your balance is going to go down by at least $50 every month. Now, as I mentioned earlier, all the income-driven plans cross-pollinate with each other. So let's say, so for some people, the RAP is going to be cheaper than income-based repayment, and for other people, it's going to be more expensive. But let's say you really want that interest subsidy, and that's really going to benefit you because your monthly payment under either plan is a lot less than the interest that's accruing. You could go over to the RAP and then switch back to IBR later. So you get the 25 or 20-year forgiveness rather than the 30-year forgiveness. Now, I mentioned that there are some regulations that are in draft form. That is one that the way the draft regulations are written, you can flip back and forth between IBR and the RAP as often as you like. But that's not something that is written specifically into law, so that could change by the final regulation. So that's something to triple check on if that is your strategy. Um, if you're married and you file your taxes jointly, they're going to use both incomes. Um, if both spouses have loans, um, and this is something else that is in the draft regulations but could change, they will still prorate between the two. That was something they fought a lot about at negotiated rulemaking. So that's something I'm very tenuous on about prorating between both borrowers. The new tiered standard plan, which remember, if you're a Parent Plus borrower and you borrow or consolidate on or after July 1st, 2026, this is the only plan you're going to be able to get. It works very similar to consolidation. If you owe less than 25,000, you're going to get a 10-year term and an equal payment every year. Now that will be PSLF eligible. But if you owe less than 25 grand, you're probably going to pay your loans off before getting PSLF anyway. But that is PSLF eligible. If you owe between 25 and 50, they're going to give you a 15-year term, not PSLF eligible. If you owe between 50 and 100, 20-year term, not PSLF eligible. If you owe between 100 and greater than 100, if you owe over 100, it's going to be 25 a year, which is not PSLF eligible. So again, for anybody who borrows, whether you have a Parent Plus loan or not, if you have a Parent Plus loan, you're only going to be able to get the tiered standard. Everybody else, you're going to lose access to all the plans I talked about and will only be able to get the tiered standard and the RAP on all your loans, including your older loans. All right. Again, we're running. I will take questions again at the very end, but I want to make sure we cover the new loan limits as well. So for undergraduate students, where the student is the borrower and they're taking out Stafford loans, nothing has changed as far as annual loan limits or aggregate loan limits. So nothing has changed for you. Parent Plus limits have changed. So right now, you can borrow for each dependent undergraduate student you have up to the cost of attendance minus whatever other aid they already got. Starting July 1st, 2026, you're only going to be able to borrow $20,000 a year per dependent undergraduate student and no more than $65,000 per dependent undergraduate student. So if the school's expensive, you might run out of borrowing capability under the Parent Plus program. So, like I said, it's so important to plan the long term, not just the short term. And again, remember, you're only going to be able to get that tiered standard plan. So let's say you have 4 children and you borrow the max for all 4 kids, you're going to owe $260,000 and you're not going to be eligible for any lower payment options. Graduate students, Grad Plus loans, which allowed you to borrow up to the cost of attendance, are not going to be available. And you're going to be limited unless you're considered a professional degree student, which is limited to the degree programs at the bottom of the slide. You're only going to be able to borrow $20,500 per year for a maximum of $100,000, not including your undergrad, whatever you borrowed for undergraduate. Professional degrees can borrow 50 grand a year, up to 200,000, not including what you borrowed for undergraduate. Now you are grandfathered into the old loan limits if you are enrolled in a program as of June 30th and you previously borrowed a direct loan for that program. If that's you, they're going to grandfather you into Grad Plus and the old loan limits for the lesser of 3 years or when you should have completed your program. So let's say you're in a 2 years master's program, you'll have 1 year left to borrow under the old limits. All right, and that's it. Again, I'm sorry I went over a little over time, but I'm happy to stay even longer to answer other questions that have come up or things that might need further clarity. Addison, what do we got?
Nothing else for me at this time.
Fame friends, is there anything that you think that you wish I covered or you think needed more clarity?
No, I think this was amazing as always, Betsy. I think that we have gotten some questions about PSLF. People really probably wanting to understand their specific scenarios, but Addison has responded back to them. That's the perfect time to email your organization. I will send a follow-up email with the link to the recording. I'll remind people of that email address. So those sorts of questions can come your way and you can help people sort that out. And of course, there is the PSLF tool on studentaid.gov, and that's always the best place to start is to make sure that people have signed into their studentaid.gov account, checked out their loans, and use that PSLF tool if they're pursuing public service loan forgiveness. Thoughts on any of
Absolutely.
that?
The other thing I'll add is that keep an eye on Fame, other future events. I know that they like to do a PSLF webinar once a year or so.
Yep.
I'm not putting you on the spot. Maybe
Nope,
you
we
haven't
will.
decided to do that. But also we offer PSLF webinars to employers that are PSLF qualifying employers. Uh, we do have to charge a small fee for that to the employer, not to the employees. But if you work for such an employer, you may want to recommend that they offer a PSLF webinar to all of you. It can be really beneficial to both the employer, actually, as well as the employees.
Absolutely. That sounds great. Yes, we will definitely be scheduling more webinars on a variety of topics that are connected to student loan repayment and borrowing. And so, yeah, watch for those. So, anything else? I think we're good. I've got one more question here that I'll respond to, but I think we're good. Addison, amazing as always. The two of you together, holy cow, what a team. So, thank you so much. I'm gonna stop recording and
And let's all pray that the